Great, thank you. All right, so the question that we ask here is, does responsible investing come with high or low returns? This is one of the central questions in sustainable finance, and it's a question where there's a lot of strong opinions. You have some folks saying, of course, sustainable green firms must have high risk-adjusted returns over the long run, but you also have others saying, no, actually, look, if anything, it's false. If anything, what's happening is because of sustainable investing, we're having low returns and ultimately allocating capitals to the wrong types of firms. There's a growing academic literature on that topic. I'm not going to review it all, where we come in together with Laurent Calvet from Schema Business School and Evan Zhou from Queen's, is to provide a supply and demand framework to address that issue. So in this framework, you have investors and firms. Investors supply capital to firms. Investors are your traditional type. They seek to maximize return. They seek to minimize risk and, of course, having good ESG impact if they can. For them, the higher the cost of capital, that's a good thing, right? That's a higher expected return, and so they're willing to provide more capital to the portfolio. And then on the other side, you have firms. Firms are the ones growing the projects, right? We need the firms, but they don't have capital, so they're raising the capital from the investors. And so for them, well, the high cost of capital means it's more expensive to raise financing, and so they have a lower demand for capital, right? And so financial markets clear. We can pin down, as a result, the equilibrium price and quantity for each firm. And what's really nice in this framework is that all the traditional finance analysis that we're used to doing in a risk-return space, well, we can do it here in the supply and demand space, similar to the way we traditionally think in Econ 101. Okay? So you have on the top the cost of capital, you have the quantity of capital, you see that supply on the left chart is upward sloping, demand is downward sloping, you can pin down the equilibrium quantity and price of capital for each firm. And what's also really nice is because the quantity of a firm together with how correlated it is with other firms is going to dictate how systematically risky the firm is, right? And so you can, as a result, do the whole supply and demand analysis on the risk-return chart that we're used to working with in finance. And so when we do that, you have very clean insights that come out. What you see is that demand shifters and supply shifters are going to have opposite effect on the equilibrium. Demand shifters, if I take a firm that is more productive than the other, that firm is going to raise more capital, right? Investors require compensation for supplying more capital to that one firm. And so in equilibrium, in the cross-section, you're going to see a positive risk-return relation between the firms. Very traditional relation we're used to thinking about. Okay? However, if you have a supply shifters coming in, right? Now you have investors willing to supply capital to the firms, right? And so then the green firm, let's say, that has more appeal to the investors will receive more capital, but it's going to go down the demand curve. And so that firm is going to have a lower cost of capital in equilibrium. And so you have a negative risk-return relationship that arises. And so what do we get from that? In terms of key takeaways, well, in this framework, the ESG factors, the responsible investing comes in as a supply effect. It's a supply effect. Therefore, what's happening is that the green firms, they have more capital in equilibrium, and they have a lower cost of capital in the steady state. So you do have a negative risk-return relationship. However, in the transition phase, as investors become more green, they shift to becoming more green, so the cost of capital goes down, so the valuation of the firm goes up. And so in that short run, you're going to have a positive relationship between the risk and the realized returns of the firms, which explains why different studies, depending on the type of analysis and the sample that they use, are going to get different results. What's also nice is that you can also quantify the effect for different types of firms. So whether or not it is a lonely green firm or a group of firms, the effect on the cost of capital is going to change. If it is a lonely firm, actually most of the effect is going to be absorbed by the price, because at that point the demand side is more inelastic. If it is a group of correlated firms, there's going to be more elasticity on the demand side, and so more of that effect is going to be picked up by the quantity. What's also nice is that that framework at the end is applicable to any other shifters. Here we're applying it to responsible investing, but the analysis is broader than that. Any shifters that you have in mind on the supply or demand side, take hedging demands or behavioral biases on the investor supply side, or productivity effects, scalability effects, tangibility of the assets effects on the firm side, these are firm demand shifters. All of these can be integrated in that framework in a clear, straightforward way, where we can deliver some nice insights and put the framework to use. That's it. Thank you.